Hello there, I'm Professor Indra Abeysekera. One of the learning goals in this workshop is for us to understand what are non-current liabilities and how to record those transactions. We're going to take bonds issued as an example and looking at three scenarios. When bonds issued, it is issued with the interest rate. Company decides that interest rate, the issuer. That the interest rate equates the market interest rate. That's the first scenario. Second scenario is the bond interest rate is below the market interest rate. And the third scenario is bond interest rate is above the market interest rate. There are various advantages in issuing bonds for financing purposes because it doesn't affect the ownership. It's like a liability. It is a liability. It's like a loan, but it is different. And the interest on bonds are also tax deductible. A disadvantage is that bond has to be repaid, and periodically there's a principal repayment and interest payment based on the settlement value of the bond. Interest payment is calculated based on the settlement value of the bond. So here's an example. Bond is issued and there's a bond certificate given to investors and company receives the bond selling price as cash. After the agreed period, bond has to be settled. Bond has a face value that is shown on the bond certificate that has to be settled. During the period, the bond is being used by the company. Company will have to pay interest and the principal repayment on the bond. The bond interest payment is calculated based on the settlement value of the bond at the agreed interest rate shown on the bond certificate. So there's a constant amount of cash payment on the bond. Let's say it's 100,000 is the settlement value, 5% is the interest, 5,000 then becomes the cash payment of interest every year. So the bonds are issued at interest rate above the market interest rate, then investors will react favorably and offer more money than the settlement value. So the issue value will be greater than the settlement value. If the bond interest rate is same as the market interest rate, then the issue value of the bond will be equal to settlement value. If the bond interest rate is below the market interest rate, then the issue value of the bond will be less than the settlement value because investors will not react favorably to a lower interest rate issued by the company on the bond. When the bond is being held, the interest have to be paid and the interest is calculated based on the settlement value. So there's a constant amount of interest, cash interest being paid to the investors. On the other hand, to be in sync with market reality, the market interest expense would be based on the bonds payable at the beginning of the year at the market interest rate. That becomes the interest expense. That is the market reality. So the interest expense is there to represent the market reality, and cash interest payment is there to represent the contractual reality. If the bond is issued at a premium or discount, cash interest payment and the interest expense will not match. Let's take an example. Bond issued at par value. That is, the bond interest rate equals the market interest rate, which is 5% in this example. Therefore, it is issued at 100,000 and the funds received is also equal to 100,000. So the journal entries are cash received 100,000 debit, bonds payable that has to be settled later on is 100,000. At end of the first year, interest that has to be paid based on the settlement value is 5%, is 5,000, 100,000 into 5%, 5,000, debit interest expense 5,000, and credit cash 5,000. At end of the period, bond will be settled and the cash payment is 100,000, and because the settlement value is 100,000. Let's look at a scenario where the bond is issued at a discount. Bond interest rate is 5% and the market interest rate is above that 6%. Because bond is issued at a lower interest rate, although settlement value is 100,000, company will receive less money, and in this instance it is 92,639.91. To prepare for journal entries, we need to prepare a table like this. Here's the liability, beginning liability. Company, the interest expense will be based on the beginning liability to be in sync with the market reality. Market interest rate is 6% and the interest expense will be 5,558.395. But the cash payment of interest is 5,000 based on the settlement value, which is 100,000 at 5%, 5,000. That means company is paying less cash than what the market requires. If it is paying less, then the liability keeps increasing. So for the difference here, amount that was not paid, which is 558.395, that adds to the liability. So at the end of the first year, liability becomes 93,197.845. And in the second year, interest expense is calculated based on the beginning balance, 93,197.845, and the interest expense is 5,591.871. And the cash payment of interest is 5,000. Company pays less than the market. That means the liability keeps increasing by the difference that was unpaid. 591.871 is that difference. It adds on to the liability, and the new liability end of the year becomes, end of the second year becomes 93,789.715. And you can see that the liability keeps increasing. Ultimately, at the end of the 10th year, liability becomes bonds payable, liability becomes 100,000, which is the settlement value. Here are the journal entries. Cash received at the beginning is 92,639.91. That was given to us. And at the end of the year, cash that was paid was 5,000, and the interest expense was 5,558, and the difference, we paid less than what we should have paid, and that increases the liability. And the bonds payable increases, we credit bonds payable 558.40. Now let's look at bonds issued at a premium. When bonds are issued at a premium, company offers higher interest rate than the market interest rate. So 5% interest rate for the bond that was issued, and the market interest rate is 4%. Investors respond favorably and provides more money to the company. And it receives 108,110.89. And we prepare this table here. Our beginning liability is 108,110.89. Based on that value and the market interest rate, the interest expense become 4324.439. The cash payment of interest is based on the settlement value. 100,000 at 5% is 5,000. So company is now paying more than what the market expects. It is paying more than what the market expects. So the difference decreased the liability. Difference is 675.564, and that decreases the liability, and the new liability becomes 107,435.325. Second year, our revised liability at the beginning of the year is 107.435.326, and the interest expense becomes at 4% 4297.413. Cash interest payment is constant 5,000 because it's based on settlement value and the coupon interest rate. A company is paying more than what the market expects. That the difference 702.587 is the difference, and that decreases the liability. So the new liability at end of the second year becomes 106,732.739. So you can see that the liability keeps decreasing, and ultimately it becomes the settlement value 100,000. So in all three scenarios, the settlement value is 100,000. In the first scenario, there's no difference between the market interest expense, and the coupon rate. That is when it is issued at par value. When it is issued at a discount, then we are paying less cash than what the market expects. So the bond liability keeps increasing from lower amount to the settlement value. When it is a premium, we start with a higher value, and the liability keeps decreasing and becomes 100,000. And the settlement value is 100,000. we reach the settlement value in all three scenarios.